2020 was a challenging year. It was also a year that didn't play by traditional playbooks. And 2021 isn't going to be a year of a traditional business cycle recovery. It's going to be a year of vaccine-led restart. After a challenging first couple of months of the year, we expect vaccine deployment to lead to a very aggressive restart of economic and social life. We think inflation is going to begin to firm across the course of 2021, but at the same time, central banks are likely to hold interest rates relatively constant. That combination, stronger growth, and constant interest rates in the face of some firming inflation is a very positive backdrop for risk assets, and that's why it's our core conviction for investors going into next year. The second key investment takeaway for next year is that we think investors should barbell their risk exposures. The first part of the barbell goes to getting exposure to some of the secular tailwinds, in particular, getting access to the global technology sector as expressed through an overweight to US equities and the quality factor. The second part of the barbell is getting exposure to cyclicality. 2021 is going to be a year of vaccine-led restart, but drawing a line between cyclical exposures that can outperform in that environment, things like US small caps, high yield, broad emerging market equities, and those that face secular headwinds, like we think European equities, Japanese equities, and the value factor. The bottom line is we're positive on risk assets going into 2021, both global equities and global credit. And we think it's important for investors to barbell their risk exposures next year. On one hand, harnessing the upside from the global restart, while on the other, continuing to get exposure to secular tailwinds like to technology.